Did you know that right now, about 62% of Americans invest in the stock market? In theory, with the S&P 500 nearly doubling over the past 5 years, you'd think most people are getting rich fast, right? In reality, it's quite the opposite. The top 10% of wealthiest Americans hold 93% of all stock market value. That means the rest of us, more than half the country, is sharing the remaining 7%. This highlights a simple but crucial truth. How you invest determines how much wealth you actually build and whether you truly benefit from the market at all. Part 1. Billionaires and how they invest. So, what do billionaires actually do to control and grow their wealth? One of their main tools is private equity. Private equity is all about putting money into private companies, promising startups, or family-run businesses that are on the rise, long before they ever hit the public stock market. Here's a simple example. Jeff Bezos invested in Google back in 1998 when it was just a garage project. Peter Thiel backed Facebook while Mark Zuckerberg was still a college student. Elon Musk got involved with Stripe before it became a global phenomenon. The returns they make aren't just 10% or 20% a year. They can be 10 times, 100 times, or even 1,000 times their original investment. Of course, playing in this arena requires two things most of us don't have: massive capital and world-class connections. But knowing about it isn't meant to discourage you. It's to understand their mindset. They don't chase short-term gains. They invest in long-term value before the rest of the world even notices. But private equity is just part of the story. Another unique strategy many billionaires use is called buy, borrow, die. It might sound like a gimmick, but in reality, it's one of the ultimate ways to build and preserve massive wealth across generations. Here's how it works. First comes buy. They buy assets, stocks, real estate, entire companies, and then they hold them. They hold them for a very, very long time. Why? Because in the United States and in many other countries, when you sell an asset at a profit, you have to pay capital gains tax. For wealthy individuals, that tax can easily reach 20–30% or even more. By not selling, they avoid paying millions, sometimes billions, in taxes. Meanwhile, their assets continue to grow quietly in the background. Next is borrow. When they need cash to fund a lifestyle or buy a yacht, they don't sell their stocks. Instead, they go to the bank and use their massive portfolio as collateral, borrowing money at extremely low interest rates. This borrowed money is not considered income, which means it's largely tax-free. They get cash to spend, while their original assets remain untouched and continue to appreciate. Elon Musk does exactly this. He has used millions of Tesla shares as collateral to borrow billions of dollars for projects and personal use. At the same time, his core assets stayed intact and kept growing in value over the years. And finally, the part that sounds the strangest. Die. When they pass away, these assets are passed on to their children. Thanks to the step-up in basis tax rule, capital gains taxes on those assets can be wiped out. Now, I know what you're thinking. Great. But I'm not Elon Musk. I don't have billions of dollars in stock to use as collateral. What does this have to do with me? Part 2. How ordinary people should invest. We, as ordinary people, can't play by the same rules as billionaires. But that doesn't mean we're doomed to fail. Here's the key takeaway from today's video. We can't copy their exact tactics, but we can adopt their mindset and principles. So, how should someone like you or me invest? First, don't believe you can beat the market. We read a few headlines, scroll through Reddit forums, and suddenly think we've found the next stock that will multiply our money. We jump in when everyone around us is excited and bragging about gains, buying at the peak. Then, when the market corrects, panic sets in, and we sell at the bottom to cut losses. This vicious cycle of buy high, sell low repeats itself endlessly. The result? Our money doesn't disappear. It simply flows from the pockets of amateur investors into the hands of the pros. In other words, we're voluntarily handing our money to the experts. So what should we do instead? Step 1. Invest in blue-chip stocks. These are the giants everyone knows: Apple, Microsoft, Coca-Cola. They've stood the test of time, have solid business models, generate massive profits, and pay regular dividends to shareholders. The strategy here is simple. Buy and hold. You own a piece of the best companies in the world, and let time do its work. Your money grows along with the growth of these businesses. But there's a risk. If you only invest in one or two blue-chip stocks and something goes wrong with that company, your entire portfolio takes a hit. That's why the second option, often the best choice for most people, is index funds and ETFs. For example, when you buy an ETF that tracks the S&P 500, you instantly own a small piece of the 500 largest United States companies. A little Apple, a little Microsoft, a little Amazon, a little Google, all in a single transaction. In the United States, the most common way to access these funds is through retirement accounts like 401k or Roth IRAs, which also offer significant tax advantages. The strategy remains the same. Invest consistently, hold tight, and let the power of compound interest and overall economic growth work its magic. The benefits of this approach are undeniable. Extremely low costs, minimal effort to manage, and excellent long-term results. Legendary investor Warren Buffett has repeatedly said that, for most people, a low-cost S&P 500 index fund is the best investment they can make. Finally, there's diversification. The classic saying, "Don't put all your eggs in one basket," has never been wrong. But diversification goes further than that. It's not just about owning many different stocks. It's about spreading your assets across different industries, geographic regions, and even asset classes. If the tech sector struggles, healthcare or consumer goods might perform well. If the United States market stagnates, international markets could be booming. So, what's the final lesson here? The path to wealth for the ultra-rich can be incredibly complex and out of reach for most of us, but the core principle they follow is something anyone can apply. The golden rule for ordinary investors can be summed up in a few words. Invest consistently, hold for the long term, let your money grow through compound interest, and always diversify your portfolio. This isn't a strategy to make $1 million overnight, but it is a proven path to building financial freedom in a sustainable way over 10, 20, or even 30 years. Thanks for listening. If you found these insights useful, don't forget to hit like and subscribe so we can continue exploring smarter financial strategies together. See you in the next video.